So we'll talk the conditions that will result in various forms of international arbitrage and the realignments, and we'll also talk about interest rate parity. Okay. So here, what is arbitrage? Anybody? What is meant by arbitrage? Okay. So there are three things. One is it talks about the risk. Okay. And what he was saying was, in this case, you want to have an investment where you take no risk. Anything else? So there are three elements to an arbitrage opportunity. So the first is you should not be taking any risk. What is the second one?
The assumption of there's all symmetric information.
All symmetric information, okay?
Like all the information available to everyone.
Okay. Yeah. Some contracts. So if you look at an arbitrage opportunity, it talks about three things. One is you want to have an investment where you take no risk, okay? So that's correct. The second is you want to have no investment, okay? And the third is you have positive profits. Okay, so these are the three things you want to look at, and where you do not put down any money, you will not take any risk, and at the same time you have the ability or the opportunity to make money. So in the case of futures or in the case of options, the underlying assumption is that there are no arbitrage opportunities. Okay, so sometimes if you don't want to talk about these things, another way to refer to that is basically it's saying that you do not have any free lunches. So people say that you do not have an opportunity to get a free lunch every day. And another example would be there are no money machines where you can go and take the money out as much as you want. So these are a couple of more like ad hoc ways to define the arbitrage. People say that you have no free lunches or it's like a money machine. But in strictly, these are the three things. You are looking at an investment where you take no risk, where you have no investment. At the same time, you have an ability to make profits. Okay? So here, we'll talk about three types of arbitrage, okay? And the three types of arbitrage are locational arbitrage, okay? We talk about triangular arbitrage, and the third one is we talk about interest arbitrage. I think the locational arbitrage is the easiest one, okay? We're going to talk about that first. The covered interest arbitrage is a little more difficult. We'll talk about that next. I think the most confusing is the triangular arbitrage. What I'm going to do is talk about the first two before the break, and then the triangle. I think once you do a couple of problems, I think things become a lot more clear. Triangular arbitrage. Okay? So let's look at the easiest one. What is meant by the location? Defined as the process of buying a currency at the location where it is priced cheap and immediately selling it at another location where it is priced higher. Currency, in the example we're going to look at, basically what it says is that you have different banks. We talked about foreign exchange codes, and in this case, the foreign exchange codes are slightly different. So they could be different by a penny. If you are able to make an investment, and if you can do the transactions, very quickly, as long as you make a big investment, there's a good chance you can make. So there is a very famous video I used in my seminar class. So I teach a course on options and futures, and that talks about a hedge fund called long-term capital management. And that video, it talks about arbitrage. So one of the famous quotes I remember, there is a professor called Merton Miller. He won the Nobel Prize in finance. He died, I think, some time back. But the way he talks about arbitrage is, especially in the foreign currency markets, basically he's saying that it is somebody with a giant vacuum cleaner coming by and trying to suck up pennies. So basically, a bank will be investing millions of dollars. Basically, they are trying to make $10,000 or $15,000 in one transaction. But if you can do that regularly, that adds up to a very good amount of money. So that is the way they talk about the locational arbitrage. And here, gains from locational arbitrage are based upon the amount of money used and the size of the discrepancy. So basically here, it depends on about two things. One, how much money you can invest. So let's say you invest $1 million, you can make more than if you invest, let's say, $100,000. It also depends upon the size of the difference. So what is the difference between the quotes given by the two banks? And realignment due to locational arbitrage drives prices to adjust in different locations so as to eliminate discrepancy. So basically here, what we are saying is that as soon as people find that there are some small differences, chances are they are going to trade and make profits from that. If you look at this example, we have two banks, and quotes given by the two banks are slightly different. Okay, so let's look at the quotes here. Okay. So when you look at the quotes given here, for the first bank, the bid price is 0.635, the ask price is 0.64. And for South Bank, the bid price is 0.645 and the ask price is 0.65. So what we see, there is a small difference in the quotes given by the. Now, when can you make any profit? You can make any profit, you ask bank or bank. So you have to buy the currency from the first bank to the second bank. If the ask price of the first bank is lower than the bid price of the second bank, you can make profits out of that. Okay, so that's what we see here. This is for the New Zealand dollar, and for the bid price of the first bank is 0.635 and the ask price is 0.64. So for the first bank, you can buy the New Zealand dollar at 0.64. If you want to sell the New Zealand dollar, you will get 0.635. Okay? Now for the second bank, the bid price is 0.645, so if you want to sell the New Zealand dollar, you get 0.645, and if you want to buy, you got to pay 0.650. We say that we can make some money. The reason why we say we can make some money is because the ask price of the first bank, which is 0.640, is lower than the bid price of the second bank. So how can you make money? We can buy it from North Bank at 0.640 and sell it to South Bank at 0.645. Okay, so that is what we are saying here, to make an arbitrage profit. Okay. So here, buy from North Bank. Okay. That would be 0.640. Sell to South Bank so the difference is 0.005. That is half a cent. So it doesn't look like a lot of money, but what we are saying is that, let's say you can invest, let's say $1 million. Okay. So that gives you $5,000, yeah? That's what is correct? So that's what we are saying here. So even if you find a small difference like this is half a cent. If you can buy it from North Bank at 640 and you can sell it to South Bank, you can make a small profit that is $5,000. Now clearly, if you see quotes like this, they will not be out there for a long time period. Chances are it's going to be a very short time interval, which means that usually it might be difficult for humans to do this type of trading, or you've got to be very quick in your trades. $5,000 on an investment of $1 million, but chances are you might be able to do this in 10 minutes or 20 minutes. So that's what we are saying here. If you can do this consistently, maybe even a couple of times a day, that's $10,000 a day, that would be $200,000 a month. That is a very good return on your investment. Okay? So that's what you see here. Use the US dollar to buy the New Zealand dollar for 0.64 and take the New Zealand dollar purchased from the North Bank and sell it back to South Bank in exchange for the currency. Okay? So there's a second example. Bid price of the New Zealand dollar is 0.401, and for Yardley Bank it's 0.398, and ask price of the New Zealand dollar is 0.404, and for Yardley Bank that is 0.400. So how do you make it here? So here, in this case, what we see is that the ask price of the New Zealand dollar is 0.404 for Beale Bank, and it's 0.400 for Yardley Bank. Okay, so you buy it from Yardley Bank at 0.400 and sell it to Beale Bank 0.401. Okay, so again, it's a small profit, but if you can do this consistently, that can be a good amount of money. Okay. So buy from Yardley, okay, and here that is 0.400, and sell it to Beale, that is 0.401. So the profit here is $1,000 on an investment of $1 million. Okay. Okay. So what I want to do is, like I told you, I want to talk about the next one. I think the little bit easier one is we talk about the interest rate parity. Okay. So here we want to talk about interest rate parity, and as far as finance is concerned, that is perhaps one of the most important relationships. Okay? And here, what is interest rate parity? So before we talk about covered interest arbitrage and so on, we want to talk about what is meant by the interest rate parity. Okay? So here, we want to talk about F by S. So here, F is the forward price. Okay? And S is the spot price. Okay? So here it talks about the relationship between today's exchange rate and the forward exchange rate. And what does it tell you? Basically what it tells you here is that F by S is given by 1 plus the interest rate by 1 plus the interest rate raised to T. So this is the relationship between the forward price and the spot price. And here, our US is the interest rate in the US. So our US is the US risk-free rate. And our F is the foreign risk-free rate. So these are interest rates. So it tells you that there is a relationship between today's exchange rate and the forward exchange rate. That depends upon the interest rate in the US and the interest rate in foreign problems and so on. This formula, exchange rate is as a direct rate. So you definitely want to be careful. If the question says something else, you want to make sure you convert it into a direct exchange rate. Okay. So here, F is the forward price as a direct rate, and again S is the current exchange rate as a direct rate. Because sometimes, if you look at another book, you might find that formula could be upside down. And the reason why the formula is upside down is because the interest rates could be, an indirect rate. Okay, so that's the reason why you definitely want to be careful when you use the formula. Okay. So here, so if you move things around, okay, so what it tells you is the forward price, today's exchange rate times 1 plus the interest rate in the US divided by 1 plus the interest rate in the foreign country raised to t. Okay? Or if you want to do an approximation, okay, so there are different ways you can write down this formula. Okay? So typically, as far as we are concerned, we will write it like this. When you look at the forward price that is given by today's exchange rate multiplied by 1 plus the interest rate in the US divided by 1 plus the interest rate in the foreign country raised to t. Okay? Now sometimes when you take finance in some classes, one of the assumptions you make is you get interest rate continuously. Okay, so basically here we are going to assume, let's assume that you're getting interest all the time. If you get interest rate continuously, some people use this formula. Okay, and here you can either use E equals 2.718, okay, or in your financial calculator you have an E raised to X. You could use that, but like I told you, we don't really have to worry about that. You'd rather go with the one I wrote down first. That's a little bit easier. You don't make any mistakes and so on. What is an approximation? You can also have an approximate answer, and the approximate answer is F is given by today's exchange rate times 1 plus the interest rate in the US minus the risk-free rate in the foreign country raised to t. Okay? Now, what does it tell you? If you look at this formula, okay, basically what it tells you is what is the relationship between today's exchange rate and forward exchange rate. And here what it tells you is that is pretty much given by the future value of the spot price. Okay, so all of you took Finance 650, you talked about the time value of money. So essentially here, when you talk about finding the forward price, in some way what we are doing is we are finding the future value of the spot price. Okay? And to find the future value, what is the interest rate we are using? The interest rate we are using is the difference between the US interest rate and the foreign country's interest rate. Okay? So that's what we are doing here. We talk about forward price. So as an example, let's say interest rate in the US is 4%, okay? The interest rate in the foreign country is 2%, and the spot price is, let's say, 0.8, okay? We could plug in the numbers here, and as an approximation, okay, what we find here is F is equal to 0.8, okay, times 1 plus 0.04 minus 0.02 raised to 1. If it's 1 year, so that gives you 0.8 times 1.02. Okay? So that's what you get here if you do it approximately. So what does it really value, essentially it's like find the future value of a single sum. Today's value, the present value is 0.8, the interest rate is 2%, and the time is 1 year. So that's pretty much what we are doing when we talk about finding the future the futures price given the spot exchange rate. Okay, so that's what we see here. So the futures price is basically the future value of the spot price. Okay. So if you look at this formula, okay, given these numbers, what does it tell you about the currency? Is the currency increasing in value or is it decreasing in value? What do you think? Increasing? So that's a bit confusing, okay? And the reason why I'm saying it's confusing is because this is a direct exchange rate, okay? So here what we are saying is that today you have to pay $0.8 for 1 unit of the foreign currency. So let's say it's for the New Zealand dollar, today you pay 0.8 US dollars. But 1 year from today, you are paying 0.816, isn't it? You are paying more. That's what it says. Yeah. Value decreasing, isn't it? So when you say that the forward price is greater than the spot price, essentially what it tells you is that the value of the US dollar is actually decreasing, isn't it? You are paying more US dollars for the same unit of the foreign currency. So that's what it says here. Okay. Now, if you look at this, so defined as the process of capitalizing on interest rate differential between two countries while covering your exchange rate risk with a forward contract. Now, as far as the technical relationship does not, the forward price is higher. As an investor, you can make some profits out of that. So that is what is meant by the covered interest arbitrage. So in the case of the covered interest arbitrage, as far as the textbook is concerned, what it tells you is that whenever the forward price is higher than this, okay? So for example, we plugged in the numbers and we found that the forward price should be 0.816. The forward price, let's say it's 0.85, as an investor, you can make some extra profits. Okay, so there we are saying that as an investor, you will have an arbitrage opportunity. Okay, and here what we are saying is that just like anything else, it's not going to be there on time. Okay, so chances are, whenever people find this, they will make use of that and they will try to profit that. So that is what we see here. Realignment due to covered interest arbitrage causes market realignment. So chances are, when everybody trades and tries to make money out of that, chances are here. And timing of realignment may require several transactions before it takes place. Okay? So as we said before, as far as international finance is concerned, this is a very important concept. So here, interest rate parity is arbitrage condition. So what we are saying is that whenever we find this does not hold, chances are banks and other investors will try to profit from that. Okay? And here, if interest rate parity did not hold, it would be possible for an astute trader to make unlimited amounts of money exploiting the arbitrage option. Since we don't persistent arbitrage conditions, we can that IRP holds. Okay? So basically here, what we are saying is that of all the theories we talk about, so chapter 7 we talk about some theories, chapter 8 we talk about other theories such as purchasing power parity and so on. But of all the things we talk about, the only one that really holds exactly is the interest rate parity. And the reason why it holds exactly is because chances are people will try to exploit and make money whenever there is any mispricing. Okay? So let's look at this example. Okay? Okay, suppose you have $100,000 to invest. So there are two things you can do. One is keep the money in the US, okay? So if you keep the money in the US, you can invest at the $100,000 you have, you get 1 plus RUS, okay? So that's what we get. You can keep your money in the US, you end up with the future value, okay? So in the example we have, okay, so let's say it's 4%. In this case, the future value is going to be 104,000. Yeah, that's what we said. Okay, so that is the 100,000. Okay, times 1 plus RUS. Okay, so this is one strategy. Keep your money here, and you end up with, let's say you invested 4%, you end up with $104,000. Okay, the second choice is you convert your money. Okay, so let's say that rather than keep money in the US, let's say you want to invest in Japan. Okay, so you want to buy the Japanese yen. Okay, and if you buy the Japanese yen, how much do you get? You get, okay, 100,000 divided by the spot exchange rate, isn't it? So basically here, let's say the exchange rate is 0.1, okay? You end up with 1,000,000 Japanese yen, isn't that's what we get, okay? So you can either keep your money in the US or you could perhaps invest in the foreign country. So if you invest in the foreign country, you convert today, okay? And let's say the spot exchange rate is S, this is how much you get, and you can invest in the foreign country. So here, that would be plus yen, okay? So whatever the interest rate is in Japan, you're going to get that interest rate, okay? And then at the end of the year, what we are also doing is that we sold a forward contract, okay? So that's what we do here, convert into yen. At the same time, we convert back into okay. So when you sold a forward contract today, essentially after 1 year, you had the right to convert your money back into US dollars. And the good thing is that by selling the forward contract, you are guaranteed the exchange rate. You're not concerned about any risk, okay? So what do we have here? At the end of the year, if you convert your money back, okay, how much would you have? So basically here, how much you have is, you will have 100,000, okay, divided by S, okay? So if you had 0.1, you end up with 1,000,000 yen, and whatever the interest rate is, okay? And here, you're converting your money back at the forward price, okay? So at the end of the year, whatever is the forward price, you are able to convert your money back, okay? So this gives you the future value of how much you end up with. So what we are saying here is that in either strategy, whether keeping your money in the US, this is what you get, or converting into Japanese yen, investing in Japan, and selling a forward contract to bring your money back to the US, this gives you the answer, okay? So all we are saying here is that in either case, at least based upon the numbers initially, you should have the same future value, okay? So whether you keep your money in the US or whether you keep your money in Japan and bring it back in 1 year, you should have the same future value, okay? So what we are trying to do here is that we are trying to figure out what should be forward price, okay? So based upon these numbers, what should be the futures price or what should be the forward price, okay? So what should be the forward price? So when you compare these two things, keeping your money in the US gives you this much, okay? and keeping your money in Japan and bringing it back So this is the left-hand side, and that is the right-hand side, and they should be equal. Okay. So what does it tell you? So all that we are trying to do here is that we are trying to show that what should be the forward price, okay? And how do we do that? Basically, what we are saying here is that whether you keep your money in the US or whether you invest it in Japan and bring it back after the year, you should have the same future value, okay? Otherwise, people might prefer one over the other. So that's what we are trying to prove here, and it talks about how you end up with the parity, and that is the relationship between the forward price and the spot price. Okay, so we already talked about the formula, but this basically tells you how you can come up with the formula. Okay. Now, if you look at the textbook, it talks about the forward premium or discount, and here F by S is given by 1 plus the interest rate in the US divided by 1 plus the interest rate in the foreign country. The same thing we talked about. And if you talk about the forward premium or discount, what does it tell you? When you talk about the forward premium or discount, what it tells you is, so here, the forward premium or discount is F minus F over S. And here, what we're saying is that it is given by 1 plus the interest rate in the US divided by 1 plus the interest rate in the foreign country minus 1. Okay? So basically here, what we are saying is that when you look at the forward premium or discount, that is given by the difference between the interest rate in the US and the interest rate in the foreign country. Okay, so what does it tell you? What it tells you here is that if, let's say, interest rate in the US, okay, is 4%, okay, and the interest rate in the Japanese is 2%, okay. So if these are the interest rates, what it tells you is that roughly, it's not exact, but over the year, what we are saying is that the value of the US dollar should go down by 2%. Okay, that's what we are saying here. So when you compare the forward price and the spot price, the forward price will be 2% higher than the spot exchange rate. Or what we are saying is that the value of the US dollar should depreciate by the difference in the interest rates between the two countries. Okay? Yeah.
Make sure the forward rate in that formula, it should give you the same amount of dollar.
That's what we're saying here. Okay, whether you keep your money in the US, this is the future value, or whether you invest in Japan and bring it back, you should end up with the same future value.
Which is 10
Yes, yes. Okay, that's what I'm saying. So I think when you look at one problem, it becomes a little more clear, okay? So let's look at this example. Okay? The spot price is 0.8. Okay, so today's exchange rate is 0.8. The forward exchange rate is 0.79. The 90-day Canadian interest rate is 4%, and the 90-day US interest rate is 2.5%. Okay. So it's a little bit confusing. Okay. So one of the things to be careful about is that how are interest rates expressed. Okay. So usually, most of the time, when 4%, what it typically means is that is the annual rate. So that's the way we usually talk about interest rates. But I think as far as this textbook is concerned, at least in some of the problems here, what we are assuming is that that is a periodic rate. Okay? So rather than an annual rate, the interest rate here is the interest rate for 90 days rather than for the year. Okay, so that's one thing you want to be careful about. But chances are in the exam and so on, I'll make it clear whether it's an annual rate and so on. Okay, so if it says nothing, you can typically assume that is the annual rate. Otherwise, it'll say it is the periodic rate. Okay, so if here the spot price is 0.8, the 90-day forward rate is 0.79. The 90-day interest rate in Canada is 4%, and the 90-day US interest rate is 2.5%. Okay, so these are the numbers, and given this information, the yield from covered interest arbitrage. Okay, so that's what the question says. So chances are, okay, for the exam and so on, if you get a question, there could be two parts. The first part is, what is the forward price? And the second part would be, what are the profits from covered interest arbitrage? Okay, so typically, I'd like you to find out the forward price first and then see whether you can make any profits from covered interest arbitrage. Okay, so what is the forward price? So if you want to talk about the forward price, based upon the formula, this is what we said. F by S is given by 1 plus the interest rate in the US divided by 1 plus the interest rate in the Canada. Okay? So this is what we do here typically. Now in this case, like we said, U is the peak rate, the 4% and the 2.5%. Okay? So you don't have to worry about converting anything. The interest rate is a quarterly rate, and the time period is 3 months. Okay. So how can you find out the forward price? So based upon what we can find out the forward price. Okay. So here, the forward price is given by .8 times